Hey guys, welcome back to my channel. In today's video, I want to go over some other economic trends that I have been noticing. And the first thing I want to talk about here, and this will probably be the crux of my topic today, is to talk about the real gross private domestic investment. Now, this is your investment component of GDP, which we use to calculate the economic growth. Now, as I mentioned in my previous video, which I'll post a link to, the GDP is really just measuring the consumption side of the economy, what we are consuming on the back end, because the theory is that whatever we are purchasing must first be produced, so it is a measure of what we have produced in totality. And in my opinion, that can be misleading to the actual growth of the economy, because it does not measure the production structure of the economy of what it takes to create those goods. But I covered that in a previous video. In any case, this is the investment component of GDP. So GDP is composed of four major pieces. You've got your consumption, your private consumption. You've got your investment, which is right here, your business investment, and then you have your government spending component of GDP. So it's whatever government has spent that has been moved into an investment into the economy and direct. And then you've got your exports minus your imports, okay? So what we call net exports, right? Almost all schools of economic thought, okay, whether you're from a classical Austrian school, which is, the school of thought that I tend to hold to, or whether you are monetarist or neoclassical or Keynesian or none of the above, nearly all schools of economic thought agree that this investment component of GDP is the key to economic growth. You have to invest in the future. Where the schools of thought argue and bicker with each other is how to stimulate, or what causes this investment component of GDP to grow, okay? They all agree that if this component is not growing, or worse, shrinking, then that's a sign that the economy is weakening. And you can see here that in every single cycle, right, in every single cycle, when the investment component of GDP starts to drop, this is real gross private domestic investment, by the way, so we are stripping out consumer prices here, then this leads to economic recession, okay? It does not necessarily mean that it will be an economic recession. For example, in Q1 2015, your investment component of GDP did kind of shrink a little bit, but that's because resources were reallocating out of the oil sector thanks to the high productivity of shale oil, allowing us to tap into new energy sources in a cheaper and more efficient manner to increase the supply of oil, which dropped production cost all across the board. So in my opinion, my previous video, I covered how you can capture the producer side of the economy by taking gross output and subtracting out GDP and then controlling for producer prices. I think that's the better way to measure the producer side of things. However, I do agree that this investment component is what remains of what we have not consumed off the market that has been produced, that we are reinvesting back into the economy to cause higher GDP numbers, okay? Now, all that being said here, I want to dispel a couple of modern myths about economic theory today. So the modern myth today is that government spending can invest in the economy and cause higher growth. This chart stands to differ from that, okay? So in red here is your percentage of government spending as a percent of the economy, measured here on the right axis, and on the left is the gross private domestic investment as a measure of GDP, okay, as a percentage of GDP, and that's measured on this axis on the left. Notice how, as a percentage of GDP, your gross private domestic investment component keeps dropping, okay? Your investment component is dropping, so we're investing less and less of our GDP back into the economy, which is causing weaker economic growth, okay? But in essence, we are increasing government spending. We've been increasing government spending slowly throughout time as a percentage of our economy. So the more that government is consuming off the economy, the less we have to invest, okay? Now, Keynesians like to say that that's wrong and that what they're actually doing is stimulating investment, because if you notice here, after every economic cycle, government spending as a percentage of the economy increases either from economic contraction and or plus stimulus spending, so a higher so-called investment component out of government spending, and then years later we reap the rewards in higher business investment. So they believe that because demand drives the economy, stimulating a drop in consumption and replacing that with government spending will then yield higher business investment in the long run. They believe this because the entire economy is driven by fear and greed, animal spirits, the bull and the bear. And when the bears take over, it's time to replace those bears with the bulls, and the only way to do that is for the government to lead the way and restore confidence in the markets, okay? But nevertheless, the long run tends to hold true that what it actually does is deteriorate government spending. In reality, the major driver of gross private domestic investment is actually not government spending, it's the total savings of the economy. So the classical school of economics is correct. Now, what I've done here in this formulation below is in blue is that you have your gross private domestic investment, but what I've subtracted out is the consumption of fixed capital, okay? So I'm taking into account net investment, what we have net invested to produce more product in the future after we have subtracted out what we have consumed on existing capital assets, okay? So any kind of depreciation, any kind of used up of tools, machinery, and equipment, I've subtracted that out. And if you notice, it ties very closely with this red line, which is a measure of the net savings of the economy. Now, these net savings right here, okay, it is your savings that we have accumulated in the private sector. So all the income that we have earned over a period of time that we did not use for immediate consumption, plus whatever savings the government institutes as well, because our government also spends and consumes, okay? So this net saving is government savings plus your private savings. Now, if you let that sink in for a second, you'll notice that government saving is actually negative because governments run deficits. And indeed, when the government decides to run higher deficits by trying to stimulate the economy through stimulus, this actually takes away from this net savings. But what that actually does is it actually hurts the gross private domestic investment component net of consumption of fixed capital. So it actually hurts business investment. All the stimulus bills and spending does is hold off the real growth of the economy. It does not help it. And this may explain why we're seeing such a weak turnout and indeed a negative turn on the real gross private domestic investment. We can see that quarter after quarter, despite higher GDP numbers, we're seeing lower turnouts of real gross private domestic investment, okay? So this could lead over time, it could lead to the deterioration of an economy and plunge the economy into recession, as basically we are investing and producing less, which will result in less product, which will then result in less consumption, which puts the economy into the negative over time. And I covered that kind of scenario in yesterday's vid, so I'll have that in the link as I've mentioned earlier. But one of the things I want to point out here is that the gross domestic product has boomed, right? And it's boomed because we have stimulated consumption to such a high degree. So large amounts of government spending and stimulus checks financed by monetary printing is causing this real GDP to go up because prices haven't caught up with it. And based off of this investment component, this is further evidence that we're going to see a deterioration in the GDP growth rate. So this red line is your GDP, is your real GDP growth rate. Your blue line is your real net investment growth rate. So once again, it's that gross private domestic investment minus consumption of fixed capital controlled for consumer prices. And you can see the strong correlation that it has with GDP growth. The more that we invest in the economy, the higher GDP growth we get, okay? And so GDP growth has been kind of deteriorating over time, and the reason why it's been deteriorating over time is because we're investing less in truthful terms. Well, why in the world did we have such high GDP numbers now? Well, that's caused by a lagging effect between price increases and your economic growth or spending, okay? So every money, all dollars that get spent don't just magically cause prices to increase right away. It takes time for these things to manifest. In the early stages of inflation, so to say, everybody benefits and nobody pays, okay? So we don't face the consequences of that monetary inflation right away with inflation of high prices. That comes later. But when inflation hits in the later stages, everybody pays and nobody's benefits. That's why it's so addictive in the early stages. That's why we have always turned to this in times past, and why governments have in times past. For a short period of time, we're allowed to have our cake and eat it too, but in the long run, it ends up decimating us. So as these prices start to build, we're going to see our investment component diminish, which will yield less and less real returns in the economy, calling for more and more monetary and government stimulus to replace it. But what we're going to be going into is a dangerous situation where we're actually eating away at our capital, much like what we did in 2008. And if we get to that point where we are actually consuming our capital, we could be in for a very weak turnout in economic growth. So this video that I'm giving you here is just sort of a supporting material for what the topic that I was talking about yesterday. But I did want to make this video and point this out to you to give you this kind of addendum information, right? This idea that, yeah, I'm not just jumping on one thing to say our economy is doomed, or two things. It's actually a multitude of things, and in this case, it's that domestic investment. That domestic investment is weakening. I believe it is weakening because we're trying to stimulate higher amounts of consumption, which is hurting our savings rate. And even though personal savings has increased, it has been encountered by high amounts of government spending. So yeah, true, your net savings did bounce up, right, and measured by this red line temporarily in 2020, 2021, brought on by fresh monetary stimulus, but now it's deteriorating again, and it's taking along the investment component of GDP with it. Thank you guys for watching this video. If you like my content, make sure that you click that like button, subscribe, comment on the channel. Let me know what you think about the video. Am I on to something, or if I'm again jumping at shadows? And on the next video that I'll make, which I'll probably either produce tomorrow or Tuesday, I'm going to be talking about some recent stock trends that have been going on. And essentially trying to gauge when we're going to see exactly that peak in the stock market. Now, a lot of that is going to be reliant on technical analysis and whatnot, but it's really all that we have to go on for an aggregate stock market indice. So make sure you stay tuned for that. I'm sure you'll be interested, and until then, I'll talk to you later.